Hi there, my name's Gordon Farragher. This brief recording looks at the VAT implications of a transfer of a going concern, something that's frequently examined in many different tax exams. So, what's going on? Normally, if you are a VAT registered business, if you sell the business to a third party, or you sell the business to another entity, for instance, you were a sole trader and you're selling your business to a company, i.e. you're incorporating, then the taxable person is disposing of assets, and the normal rule is they would therefore have to charge output VAT at 20%, and if it's a sale, it would be based on the sales price received. If it's a gift, it would be based on the deemed supply, the market value of all the assets of the business. However, if you satisfy the rules to be a transfer of a going concern, you don't have to charge output VAT on the transfer of the business. Technically, it is outside the scope of VAT, which simply means no output VAT is charged. So that then begs the question, what are these conditions for a transfer of a going concern? Well, the first thing is it's got to be an entire business. If you are just selling individual assets, that is not a going concern, and you'll have to charge VAT. So it's got to be a whole business. The person receiving the business must carry on the same type of business as the person transferring it, and the person receiving the business must either already be registered for VAT or must become registered as part of the process of acquiring the business. You don't have to actually sell all of your business, but what you sell or transfer must be capable of operating as a business in its own right. Because you might have a sort of a pub business and a food business, and you might be sort of splitting it out and transferring just the sort of food business. Well, that is a business in its own right that is capable of being transferred as a TOGC. And the last one, there must be no significant break in trade. Now, final thing just to watch out for, and a very sort of common complication, is where the business includes property. And specifically, it's where it includes property which, if it was sold, it would be standard rated. Now, we just need to think about that for a second. When would property be standard rated? Well, if it's a freehold under 3 years old in commercial property, that is always standard rated. Or alternatively, if it's more than 3 years old, but the previous owner has opted to tax the property, because that means that any future supplies of the property would be standard rated. So for this complication, we're looking for the transfer of a business, but the business includes standard rated land and buildings. Well, the general rule in this case is that the land and buildings can't come within the TOGC. Therefore, the seller has to charge VAT at 20% on the land and buildings. The rest of the assets can go VAT-free as a TOGC, but not the land and buildings. However, there is an exception to the exception. If the buyer agrees in advance that they will opt to tax any future supplies of these premises, then the land and buildings can come within the TOGC and they can be transferred VAT-free. And apart from issues about VAT recovery for the buyer, this may well also be advantageous from a stamp duty land tax point of view, because SDLT is payable on a VAT inclusive price even if the buyer can recover the VAT. So if you can have these premises transferred within a TOGC, therefore without VAT, that may then reduce the stamp duty land tax payable on the transfer.